policy between the two of them, so could be a pretty volatile morning depending on what's said there. But right now, I have an AMAT put debit spread that might be profitable. Let's see. Looks like Nvidia might be finally pulling back too, which would be reasonable to assume after, the huge pump that it's continued to see. All right, the put debit spreads I opened currently are up about $110 or about 35%. I bought them for 31, they're going for 40. I think it's a reasonable price to sell for, but if Nvidia keeps pulling back, this is definitely going to put a drag on AMAT. And given that Nvidia was yesterday's kind of market leader, it was up like 4%. I think this could weigh negatively on the chips possibly today if there is a change in sentiment today with Fed Powell coming out and speaking at 11 o'clock. If not, I might close part of the position before just to kind of mitigate the risk of that being a non-event, because I would imagine if Fed Powell speaking today is a non-event, then you might still get some more bullish pressure. But right now, SPY is trading just at 420. QQQ flat 0.03%. The Dow is flat 0.05%. And IWM leading the market at the moment, up 0.7%. So this one is still very bullish. You're looking at 62 RSI. So if we do see continued bullishness, you might see IWM up like 1%, 1.5% today. You are looking at a resistance at about 179. That's been pretty hard to pass through, but it's only about 50 cents away from it. So if you're expecting bullish today, I would think IWM might actually be your best play for today. The 10-year Treasury rate is up to 3.7%. This is the highest that we've seen the 10-year Treasury since the Silicon Valley Bank collapse back on March 10th. So this is pretty important to see it at this 3.7 level, and it's finally kind of breaking out of the range that it's been in since the SVB collapse, between 3.6 and down to 3.3. So looks like interest rates are definitely headed up. We're looking at the odds for 25 basis points currently at about 40%, 39.7% for the June meeting, 25 basis point rate hike. And then 60% chance that they're going to pause. And the gap between what the markets expect and what the Fed expects by the end of the year is actually starting to close a little bit. So this is probably what's leading interest rates up at the moment. If you look at the compare tab here, the probabilities tab, the odds are right at a 50 basis point cut by the end of this year. But this has slowly been moving, I think, from like 100 basis point cuts by the end of the year to now at 50. And the closer that we get to the end of the year, the closer this is going to be probably to 5%. Kind of wanted to take a trade on QQQ, either a neutral trade with an iron condor or a put credit spread assuming bullish neutral. It's at 43 RSI, so that's not the most promising trade for bullish neutral. The hourly chart, you're looking at it coming back down to 58 RSI, so that could be more neutral. And then putting a range on this, maybe you could stay between, I'm liking 339, 340 for the calls, and then maybe for the puts at 335, 334 today. For looking at Iron Condor, I think that would be our best trade. Looks like AMAT's coming down 2.5% now. So probably seeing NVIDIA pulling back, I'm guessing, since AMAT's getting hit now. Yeah, NVIDIA's finally down a little bit, 1.1% after like a 10% rally the past week. So not really much, but it's something. And that's putting a drag on AMAT, currently trading down 2.5% to 126.50. My guess is that AMAT's going to finish this week below 126, just based on where this rally started at about 126 and where it was supposed to be under $122. They had a good earnings. It was $2 earnings per share versus $1.83 expected. So, good little 10% beat. They beat on revenue, and they even gave good guidance. But if you're seeing NVIDIA pulling back, this has been what's leading tech to go up so much, what's leading chips to go up so much. So AMAT pulling back with NVIDIA would be the likely case for today. Looks like SPY is still kind of hanging in there. IWM is up 0.5%, actually pulling back. Dow is only positive 0.08. So it's looking a little bit more bearish to the start of the day, especially with us trading at 420.50 for SPY. It's not looking the best for bullish positioning right now. QQQ does seem to want to bounce at about 337.25 though. Let's check the big names, see what might be leading QQQ to go up today. Apple's up 0.5%. Microsoft down 0.09. Tesla 1.4% today at $180. Huh. Let's see what else. Tesla, Microsoft, we already looked at. Meta up 0.5%. Netflix was doing really well yesterday, up 10%. This is giving up 1.3%. So it looks like all the big tech names have actually pulled back a little bit. So maybe we're seeing the other names in QQQ and the NASDAQ going up and recovering. I mean, looking at what we're seeing from IWM leading up 0.5% today, so that might actually be what's going on. You might see the non-big tech names actually gaining today. Yes, 11 a.m. Eastern, Ryan. Correct. All right. My AMAT put debit spread is up about 60% now for 180 profit at the moment. Really thinking about selling a cover call on FLGT, the stock that I own 200 shares of. It's been in a range for the last couple of days, but it's up like 20% after the earnings from 28 to 36. Kind of want to take advantage of the rally, but my worry is that the rally does start to broaden. We've seen a very small breadth recently where basically all that's been leading is the 5 big tech names. And if that breadth starts to widen now, then you're going to get a little bit of a bid from the small caps because they've just not been performing year to date at all. Like if you look at IWM for year to date, this is essentially flat from 176 at the beginning of the year to 177, 178 right now. Looks like AMAT recovered a bit off of 126. Finding the lows at 126.20. Still bearish on our side, below 50. Nvidia's only down 0.6% versus down over 1% earlier. So just watching Nvidia, that's probably going to determine where AMAT goes today. If it wouldn't cost me 75 to 80, 100% of my liquidity, I would buy put leaps. Yeah, I would agree on that. Would be a good idea. But if you're buying a put leaps, you are paying a fortune on it. Let's see, for SPY, trading at 421 right now. Setting your expiration for, let's say, June 24. Even if you buy it at the money, 420 strike price, you're paying $2,500. So it's very, very expensive just because SPY is such an expensive stock. And your break even for that would be $25 lower at like $395. You'd need a pretty quick drop for that to pay out. All right. Yeah, it looks like a pretty flat morning. Similar. We're a little bit more bullish, I guess, at 51 on the RSI, but I don't know. It's looking like QQQ wants to trade flat, and if IWM is pulling back from this morning's high, that would lead that would lead SPY to the downside. Really thinking about hopping in a trade after Powell speaks, but I know if I can take advantage of it before and guess the right direction, you make more money. So I do have a put debit spread for SPY right now, assuming below 418 by next Monday, which I think could work out based on Biden speaking Sunday on the debt ceiling. Not sure if we're going to have a resolution. And I think that the markets are betting on a resolution by this weekend. And if they don't get that, I think we could see a decent drawdown, especially after the huge rise that we've seen with SPY at 420 right now. Seems like a pullback would be inevitable in that case. We're only up 0.25% for SPY right now. Just a very, very boring morning. Looks like we're going to head down here after getting rejected at 50 for RSI. And the resistance to look out for would be 420.5 today for SPY. So I'm going to look at a 421 put. Going for, they're kind of expensive today. 150. Probably just because Fed Chair Powell is going to speak at 11. Probably going to jack up the prices on these puts a little bit. 421 strike. That's expiring yesterday. We can't use that. All right. Let's look at this 421 strike. Lowest that these got was 126. They're at 155 right now, so I'd probably set my stop loss 30 cents lower. Again, assuming that we're going to stay below 420.5. And what I'd like to see here is for QQQ to go negative, Dow to maybe go back to break even at currently up 0.15%. All right. These are still kind of expensive though. 144. My stop loss would be 130. But we are just right at 50 RSI. Not super confident in the trade yet. Because 130, the stop loss could be hit pretty quick. If it does start to pull back up to like 420.6, 420.7 would knock us out of that trade pretty quick. VIX calls bought prematurely. Yeah. I thought VIX would actually pop. Usually VIX just goes back and forth between a couple of price levels, which has been mid-16s to 18 recently, but we actually saw a drop down to 15 by the end of, in the 15s yesterday and this morning. So I think that we're going to get a decent pop, but the timing on it, not so sure about. I would probably expect sometime by the end of next week. If you can, just buy regular VIX calls, that would be better than if you were to go with UVIXY, just because of the time decay with it. UVIXY has just been getting hammered every single day because the VIX has been dropping. It's down to 307. So even if you do see the VIX go up, say 100%, you're only going to see UVIXY go to like $7 or so. But yeah, looking more bearish than bullish for SPY on the 5-minute chart. But kind of just chopping around right at 47 RSI. QQQ just went to break even and just negative. So that's probably what's pulling us back. All right. And I'm looking to buy that 421 put since we've gone negative on Qs. I would like to see Dow pulling back a little bit more too, but hasn't happened yet. You would want to see this at like 335, low 335s for SPY to see a decent pullback here. All right. Stuck in 417, 418 credit spreads on SPY that expire. Got me in an account deficit. If you have an account deficit, then one of your options got assigned to you. So Robinhood, if you're using them, will probably just exercise the other one and you won't be able to trade for the day. All right, IWM looks like it's gaining some support at 177.65. Currently at 47 RSI. Let's see how much a put credit spread can pay us for IWM. QQQ is just toying around with break even right now. But if we are bullish again today, I think IWM probably has the most to gain after yesterday's losses. Put credit spread assuming over 177 is paying 18 cents right now. So it's a decent credit, given that it has to fall about $1. If you are bullish on the markets today, that would probably be a decent trade. Right now they're going between 17 and 19 for the bid and the ask, so not getting the best price of the bid. All right, looks like AMAC came back to the daily lows and popped right back off at about 126. So this one's kind of just losing ground very slowly. It seems like NVIDIA, same deal. A little bit lower, actually. Down 1.6% today. Pretty rough day for NVIDIA. All right, that put's going for 130, so I would have been stopped out there. So, glad I didn't enter it. And it looks like Dow is firming up. So that's why I didn't want to open that trade unless the Dow was going back to 335, low 335s. That would have been better, but now it's headed to 336. So that's what's keeping SPY up at the moment. Since Q's is down 0.1% currently. Still have bank puts, so if Powell could state his confidence in the stability of banks, that would be great. Yeah, banks are sounding resilient. Do I play Meta? Not really. I'm not a big fan of trading too many individual names, but let's see. I do watch them just to see what's leading QQQ. Meta's down 0.5% today. It's at 245. This one has been one that's been gaining really well for the past couple days and the last week. So it would make sense for this one to be a laggard today. Just like NVIDIA has been doing so well. These names that have been leading the market are likely to be laggers today if you see a change in sentiment. These would be, leaders would turn into bleeders, basically. And then if you don't see a change in sentiment, the leaders will be laggers. So if we're still bullish today, put credit spread will probably be okay for NVIDIA. But if we do switch to bearish today, then put debit spread would be your better trade. I'll put debit spreads right at 50. Moving back and forth. The Dow is pulling back a bit. SPY's right at 420.50. I really kind of want to open a put for a couple of weeks expiration just to give it enough time to come back, but also kind of tempted with a 0D to E put since Q's is negative and Dow is pulling back. Let's see. At 50 RSI, that's looking good. These contracts are going for 140. I'd probably, again, set my stop loss for about 130. So I could buy between 5 and 10 of these. All right. Looking to buy SPY 421 put expiring today 519 with stop loss at 130. All right, I'm gonna put actually just in the middle 8 of them instead of 10. Go back to the SPY chart, but you're seeing Dow pulling back, QQQs just to break even. We still have about an hour until Fed Chair Powell speaks. Buying these at 138 would be nice if we can. They're going for 142 for the ask right now, though. All right. I think I'm going to get them at 141 or 142. $6.95 for 5 of them. $6.95 out of 5. $139 is my entry. Opened at 139. They're going for 135 now. All right, there's a small pullback there. They're going for 142, 144. SPY dropping some more. So we'll pull up those contracts. 147 now. Should be more than that in profit. How many did I open? 5 of them. Now they're back to break even. Should have sold it there. Yeah, and it bounced right back off the lows, right at about 420.25. All right, I'm gonna get out at 145, 146. 146, and I'm out. $146 for 5 of them. Not a huge profit, but some. 7 times 5 is 35. Still got my down trade on AMAT, and I still do have some bearish positions for SPY if it does keep dropping. But Dow is back down to 0.12, QQQ back in the negative. Let's check on the big name, NVIDIA. Still down 1.5%. Trading at the daily lows. So everything's going pretty good today. Playing with my anxiety. Yeah, I got out at 146 on that put. And at 130... Let's see. 139, 146 close. Could have got more out of it. They're trading at like 150 plus now. But yeah, they're trading at 170 actually. Still have my put debit spreads. Assuming 418 by Monday. Those are about back to break even. So I'll keep holding those in case of a further downturn today. IWM pulling back, so this one's given up its gains from this morning. That's not great. QQQ down 0.15%. So everything's seeming to flip bearish at the moment. Right before Fed Chair Powell speaks in about 1 hour. AMAT's trading at new daily lows, 125.86. My puts are up about 93%. I paid 31. They're going for 60. That's actually a pretty good price to sell at, I feel like. 60 is a damn good price for those. Five screens on. We end this together. Yes, I will be streaming Powell whenever he comes on in an hour. What platform am I using on the screen? This is Thinkorswim. Yeah, so it kind of seems like we're seeing a sentiment shift from yesterday. So if we are bearish today, again, leaders will be bleeders. QQQ will lead the downside. Dow would be a little bit more neutral since it was up less, but it is still up 0.1%. IWM up 0.2%. So a little bit of broadening for stock gains with IWM performing okay. And the Qs, the big tech names, giving up their rally a little bit. No, I do not use TradingView. I use Thinkorswim personally. All right. So I wonder if we can get some VIX calls on the cheap today. It's trading at 16. Unfortunately, Robinhood only allows us to trade UVIXI, which actually I can't even trade. Let's see if I can just buy a regular VIX call with this account. Maybe, depending on the price. If we have next week's expiration, May 24th, we could assume that it'll be above 16 with the calls. You're paying a lot for it. Let's see. Buy vertical. Yeah, these are trading at 74 cents a piece, so not exactly great risk reward. You could buy just a 16 call for 122. And if VIX goes to 18 like it usually does between this range, those would turn to 2. Next week's expiration, probably not the best in terms of giving yourself enough time for it to go up, though. Meta. Yeah, I think Meta's been one of the gainers, so I think this will probably be one of the losers if we are bearish today. It's down already 1%, so it's down a decent bit, but could have more to lose depending on how Powell kind of talks to us today. If I had 2 names to go bearish on today, it would probably be Meta and Nvidia. But they are both already down 1% and 2% respectively, so not as much profit to be made as if you were to open them, say, yesterday or earlier this morning. Oh, IWM is actually pulling back pretty tough. So it almost hit 179, the range that it stayed in. And then it's just been downhill ever since that first thing this morning. And the Dow is just flat as a board. All right, we're about where I want AMAT to be. Thinking about closing these puts at 125. It's at 125.50 at the moment. The debit spreads really aren't popping off, though, with this drop. Let me check Aries and see if I get a better bid ask for their platform, because the bid ask on Robinhood is pretty atrocious right now. 40 cents and 80 cents, 45 cents and 80 cents actually. Terrible. 120, 176. I should have remembered the device. No, I was doing puts 127, 126, and they're giving me a bid at 60 and 61. No, that's expiring today. Never mind. We want next week's expiration, 26th. Puts 127, 126. Dang it. I have to refresh the page. Let's see. 26th. Puts. Buy. Sell. So they're giving me 49 and 50 and 60 for bid ask here. So a little bit smaller, but still pretty bad. Still pretty bad right now. Yeah, it doesn't seem like we have a very clear direction so far this morning. QQQ is trading flat again. It was down 0.15%, so that's recovering. And IWM was the leader this morning, and it's gone almost back to flat, only up 0.1% now. So we had a good old switcheroo. $50-50. It's all gamble on Powell. What side are we picking? Honestly, kind of think neutral. He probably won't give us anything. Watch it be just like the last Fed meeting where he didn't say anything of substance. Could be a nothing burger. Although I feel like nothing burger would actually be positive for the market. It's not bad news and it's good news is what I'm thinking. I really want to do a put credit spread for SPY, but it's a tough one. Tough one to call since we're trading so high. The risk reward just isn't in your favor. Full port the portfolio. You're thinking SPY will tank on Powell? It's hard to say. I really think that it's just going to be a non-event. Look at the way that he spoke at the last FOMC meeting. He was just kind of beating around the bush. Didn't give us any clear guidance. Looks like Nvidia might be finally getting some support at about 310 and some change. It's at 312 now. Damn, stock moves so quick. $2 in 5 minutes. Trade 0 day to expirations on that and you'll be going crazy. Damn. A 312.50 strike price expiring today for a put is going for $210. Your break even is 310.37. They're so expensive. Just for a 0 day to expiration. What's going on with PayPal? God knows. Oh, it's actually up today, 0.5%. They're trading at 52-week lows after they had really good earnings. Really don't have much sense as to why they would sell off after such a good earnings. They ended up beating revenue, earnings, and increasing guidance, but their stock sold off anyway. Even though their stock was basically already at 52-week lows, so it's just really bad sentiment for PayPal for whatever reason. All the money instead is being pumped into FANG. That's my only kind of reasoning that I could think of. Tesla's going up. Let's see. Yeah, it's at 180 now. We haven't seen 180 in a while, I feel like. Since about April, right before the earnings. But everything's just kind of trading the same. Q's up 0.1%. Dow up 0.2%. IWM up 0.2%. And then SPY actually leading today, up 0.3%. Let's check what my put debit spreads are going for. 47, 48. Thinking about taking profits here just because we're seeing a bit of a recovery for Nvidia. Kind of want to get out before Powell starts to speak in case that does flip sentiment back over. That would put Nvidia neutral today, which would keep AMAT probably at about 127 or so, which is right where my first strike, my long strike is at 127. The bid ask is surprisingly tight, 47 and 48 too. So it should be easy to get out of this trade. Tesla call is paying out. Yeah. All right, these are going for 160. Pay 31 for them, so that would be about 150 profit. Nvidia's trying to break out here. Back to the upside, but failing at about 313 so far. Still very bearish for RSI at 41. Interesting. IWM is lagging now. Everything just seems kind of equal weight today. Nothing really outperforming. Very boring morning for sure. Before Powell speaks at 11. Really wish that we could do an iron condor and make good money before 11 o'clock and Powell starts speaking, but that definitely wouldn't work. Implied volatility would just rise and increase the contract prices. 111% for Tesla. Crazy. Tesla has been one of the kind of laggers in terms of big tech names. Last couple of days since their, the investor day have been pretty good after Elon Musk opened up to advertising. And it's up from 170 to 180 in a week. Kind of thinking about taking some profits off the table for my shares. At 180 seems like a good price, maybe 190. I ought to think about trimming some of my position now soon. I wonder what the semi ETF is doing. Stocks still up about, or still down 0.5% today. Stocks has been one of the leaders recently, up from 406 to 442, almost 10% in about a week's time. So seeing a pullback here would be reasonable to expect, I would think. QQQ up from 325 to 337. Huge gains over the last week. All right, we just got rejected at about a little bit above 50 RSI actually, so that might be neutral. Price level at about 338 for Qs. And it's just about break even today. So if we do expect a drop, QQQ would be the trade to go for. Looking at the 338 put. The lowest that these have got was 108 this morning. Lowest that they've been in the past 15 has been about 115. They're going for 120 right now. So they're already pretty close to what I would cut losses at. And it's at 52 RSI. So that doesn't give me confidence to open the trade. I would want it to be below 50 to have confidence in opening that trade. They're going for 126. Again, my stop loss would probably be about 110, 115. Really want to open it closer to when Powell starts to speak at 11, but we still have 30 minutes till that. Thinking about just going short socks. I think you could just do socks L. No. I thought this was the inverse. Maybe not. Let me search for it. I'm pretty sure there's a short version of it. Just forget what it is. SOX. Bull ETF, 3 times bull ETF. Three times bear ETF. Not a huge fan of 3 times leverage, but this one's up about 2% today. Given that SOX has been doing really well, could have a decent pullback. It's at 66 RSI. So close to overbought. Doesn't really mean much. But looking at SOX S, this is trading at a low of 16. I'd probably want to get out at like 16.50, 17 at the top. Maybe set a stop loss for 16, get out at the highest today so far was 1650. Above that would be ideal. The 16 call for today is going for 35 cents. So your break even is 16.35. It has to go up about 10 cents from right now for that to break even by the end of the day. It's looking bullish for RSI at 53. I don't think I'd want to do leverage on leverage though, especially since it's a 3x. I think I'd just rather put an alert at 16, at or below. And then I want to say 1650 for profits, but 1640 has been a pretty decent resistance so far. It's about a 1-to-1 risk reward since it's at 1622. And the main thing you want to watch is NVIDIA. If it goes to new lows, that would bring SOX down and send SOX S up. All right. So I'd be losing about 20 cents a share at stop loss. Thinking about doing like 500 shares of it for 100 max loss on the trade. Let's see how much that would cost to begin with. 8,000. That's a little bit too much for my taste. All right. Well, I'll start out with, I guess, 100 shares. And it's going for 1632 right now. 1631. I bought it 1633. It's a little bit higher than what I wanted to, but buy alert, premium, just bought 100 shares, SOX S at 116.32. Again, my stop loss here would be 16. I would like to take profits above 1640. Wouldn't be a ton of profit. Probably should have done a regular call option instead. I think it just hit the break even that I was looking for with the 16 call. Let's see. Yeah, break even now is 16.45. So those went up like 10 cents with that pop. Am I streaming the meeting? Yes, I will be. It'll start at 11 o'clock. Yeah, SPY is just kind of flat. AA. We had a decent drop there, but it got saved right away. We're right at 50 RSI too. So the markets are just indecisive ahead of Powell speaking. IWM is actually leading the negative. And the Dow is positive 0.2. Really, it seems like the only thing keeping QQQ positive right now is probably Tesla stock. Since Nvidia's down 2% almost. Netflix is down 1.3. Meta's down 1.1 or 1.3. Apple's been one of the laggers, so this one's up 0.6. Microsoft, I think, one of the laggers, but down 0.25. And then Amazon down 1.05. This one's been one of the leaders too. I think Google would probably be the same. No, Google's actually still up 0.7% today. Damn. All right, QQQ just went red. IWM in the red. Dow still up 0.2. So the Dow is performing the best today. So far, what we're seeing. Still got about 20 minutes till Powell speaks, and that will choose our direction today. Let's just say not going well. Do I think Tesla's going to go up or down? I would say up or flat, most likely. Just given that Tesla has been not performing the best after earnings compared to other big tech names. So it makes sense for, if people are selling out of NVIDIA, now they're going to want to put it into something that hasn't been doing as well in order to kind of make up for that. And Tesla, this one fell pretty heavy after the earnings, so it makes sense for them to recover some of that today with NVIDIA pulling back. So I would say either flat or up today. NVIDIA's having a tough time going into the 310s. 310.84 right now. The lowest point so far today, so 310.36. Keep looking up and do what you can to improve. Absolutely. Yeah, the market's rallying recently. Definitely been out of hand. Unexpected by most, even myself. Didn't really expect us to go above 418 yesterday. I was going to take a call credit spread. Didn't do that, fortunately for me. But I did take a put debit spread expiring Monday, assuming back to 418 after we did end up crossing that, which is barely negative. I bought them at 37. They're going for 31, and I didn't buy a lot of them. All right, SOX S almost back up to 1640. Man, the calls went from 35 to 50, so that would have been a really nice gain that I could have got out of it. Still could be some more upside, but this has been the resistance today at about 1640. Nvidia's trying out the new lows, but hasn't really broke through them just yet. A lot of volume coming in. So if we get increase in sustained volume, you could see Nvidia under 310. Could get a gamma squeeze to the downside if there's enough 310 puts for today. SPY's just below 420 now. First time that it's gone. Well, not the first time, but couple times it's been below 420. It's just got bought right back up. Got about 10 minutes until Powell speaks. Maybe markets are panicking ahead of a speech. Or, I guess, conversation. Not really a speech. Yeah, looks like SPY catching support just below 420 again. Same lows as earlier, basically. The Dow is just kind of holding the pieces together right now. Server problems with IKBR. That's unfortunate. Unfortunate timing. The waiting music on the Fed's website is nice. Oh, that means that I can't start it before they start speaking, otherwise I'll get copyright. Man, AMAT is just kind of... Oh, we got NVIDIA below 310 now, so maybe if you get it some more volume going into this. Looks like volume actually decreased so far after breaking the 310 level, but if volume continues to sustain higher, you could see a decent profit taking and then a gamma squeeze to the downside below 310 today. Not sure how much it would fall. It's already down 2%, so decent drop. If it's anything like we saw for AMAT post earnings, we might see this at 305, which was yesterday's open. If it's below that, it could be pretty rough day for NVIDIA. That's another $5 though, so that's 5 over 310 is another 1.6%. Given that it's already down 2%, that would lead it to like 3.5%, 4% down for the day. Right now, a 310, 305 put debit spreads going for 140. So spend 140, you can make up to 350 best case scenario if Nvidia drops to 305. But it does look like volume is starting to trickle out. It's not super promising. All right. Let me set up the audio. Get Powell up and running. Okay. Turn off my audio output for now. Powell live. Starting in about 3 minutes. Do I like TradingView? I mean, it's $30 a month for basically what you can get from Thinkorswim. So I personally wouldn't use it just because I already have Thinkorswim. I would say probably the best thing about it is the social aspect of TradingView and being able to, I guess, collaborate with other people a little bit easier than Thinkorswim, but it has all the same studies as we do over on Thinkorswim, so it doesn't really make sense for me to move over to TradingView. Just got an alert from somewhere. Success just went above 1640. Okay. Nvidia's at 309.25 now, so sinking. The volume is still slow though. There's the man. We got him. Okay. The man of the day. And then we got Bernanke. If y'all don't know the guy on the right, that is Fed Chair, or ex-Fed Chair Bernanke from 2008 financial crisis. The man who started quantitative easing.
Water.
All right, I'm going to cut my mic and let them speak.
All right, I guess we can get started. Thank you all for being here. Of course, it is a true honor today to have Chair Jay Powell and former Chair and Nobel laureate Ben Bernanke with us today. Thank you very much for being here. I've very much been looking forward to this conversation. I'm sure our audience has too, so let's just get to it. This conference, as everyone knows, is dedicated to the memory of Thomas Laubach. And earlier this morning, we heard some personal reflections on working with Thomas from Secretary Janet Yellen, also former chair of the Fed, and from President John Williams. And both of you worked closely with Thomas as well. So I'd like to give you both an opportunity to share your own thoughts about Thomas's contributions as an economist, as a central banker, as a colleague. Ben, maybe we can start with you.
Sure, and it's great to be here. I was Thomas's thesis advisor, and he worked with me on a book on inflation targeting when he was still a graduate student. And that was a long time ago, and he was not yet in his exalted position at the Fed when I was doing Jay's job. So I don't have any short little anecdotes to give, but I do want to say that I think there are sort of two kinds of accomplishments a person can have. They can have curriculum vitae accomplishments, and they can have what I call eulogy accomplishments. Curriculum vitae accomplishments are things like published papers and promotions and awards and recognition. Eulogy accomplishments are the things your family remembers. You know, your kindness, your support, helping other people, and so on. Thomas was one of the few people who scored high on both dimensions. On the CV side, beginning with his work with me, he had a tremendous input into the Federal Reserve's framework, working on inflation targeting, working on the more recent Fed framework. He did work, I'm sure John Williams talked about his work with Thomas on the natural rate. He worked on the effects of deficits on interest rates, again, another contribution. So a person who made a lot of intellectual contributions at important points. But as a person, he was just a very warm, kind, friendly, helpful person, and he was just a joy to work with. And I'm glad to be here to say this about him.
Thank you. Jay?
Thank you, Trevor. So first of all, let me say this conference is a very fitting tribute to Tomas, and I'm really delighted and honored to be part of it. And let me add my thanks to those of us who made all of this happen here today. So I first met Tomas when I joined the board as a governor in May 2012, almost exactly 11 years ago. And in preparing to join the board, and then in the early years at the board, I was very focused on developing a deeper background in macroeconomics and monetary policy. Many people here at the board supported me in that process, too many to name here, but I will say Tomas really stood out. And it was during the process of reading the literature and discussing it that I really started to get to know him. He had this great ability to communicate complicated ideas. He obviously loved talking about economics, and his great enthusiasm and willingness to engage with me, a new governor, was immediately evident. He was very gracious to me, and we had a lot of informative discussions. So rather than being his teacher, I was really his student in those early years. As you know, by the time, as you noted, Trevor, by the time I became chair in 2018, Tomas was the head of the Division of Monetary Affairs. And in that role, he was a trusted advisor to me and to the FOMC. His leadership was particularly important as the FOMC conducted our first ever public monetary policy review. He played a major role in organizing that, identifying key topics, and organizing the staff all through the Federal Reserve System. He also played an absolutely essential role during the critical period of the pandemic at the very beginning, when we were marshaling our forces and our tools to stabilize the financial system and protect the economy from even more dire consequences. And through it all, he did come through as, not just for his dedication, his great intellect, and his mastery of monetary economics, but also just for his kindness as a human being, and just as in being a terrific, great colleague and a great person.
Thank you. I think there's a lot of agreement for the sentiments that both of you have expressed. Appreciate that. Before we get to some questions on some current issues, I did want to ask you both about any formative experiences that you may have had that have shaped your views, particularly about your thinking about monetary policy. Paul Volcker, in his oral history interview, tells the story of his mother, who was adamant that he received the same dollar value monthly allowance when he was in college that his older sisters did 10 years prior. And of course, he was not too happy about that because inflation in the interim had obviously eroded the real purchasing power of that allowance. So as the story goes, that was the beginning of his personal commitment to price stability. So Jay, do you have any such stories to tell?
Maybe not quite that on point, but so I graduated from college in 1975 during what we now call the Great Inflation, and same college year as Ben. And I started working as a lawyer in the financial sector in the late 1970s. I recall from that time a growing sense that high inflation was essentially a permanent part of the landscape, just something that we all had to accept and deal with, and that the costs of getting rid of it were too high. So you just were getting used to it. Of course, ultimately, the Fed did step up and restore price stability. And one lesson from that era is that price stability is really the foundation of a strong economy, and that the economy doesn't work for anyone without price stability. Another is that high inflation when we have high inflation, it is the responsibility and the obligation of the central bank to restore and sustain price stability. So today, while inflation isn't as high as it was when I was in college, it's nonetheless far above our 2% objective, and many people are currently experiencing high inflation for the first time in their lives. It's not a headline to say that they really don't like it. So we are very aware that high inflation imposes significant hardship as it reduces purchasing power, especially for those who are at the margins of the economy and living paycheck to paycheck and need to use all of their incoming income to pay for food, housing, and transportation and other essentials. And that's why the committee is so strongly committed to returning to our 2% goal. We think that failure to get inflation down would not only prolong the pain, but also increase, ultimately, the social costs of getting back to price stability, causing even greater harm to families and businesses. And we aim to avoid that by remaining steadfast in pursuit of our goals.
Thank you. Ben.
Well, I had mentors, Dale Jorgensen at Harvard and Stanley Fischer at MIT in particular, but I'm going to tell you about something that happened to me when I was 6 years old. I used to visit my grandparents in Charlotte, North Carolina during the summer, and I would sit on the front porch of their house and listen to my grandmother tell stories about her life. And she told about how she raised her family in Connecticut in the 1930s during the Great Depression. And it was a town that was specializing in shoe manufacture, and during the Depression, a lot of the factories were shut down. And she told me that, it was a very hard time. A lot of the kids went to school in tattered shoes or maybe no shoes at all. And I said, Grandma, why would they do that? And she said, well, because their fathers lost their jobs. Why did they lose their jobs? Because the shoe factory shut down. Now, I was only 6 years old, but I could see the problem with that argument. I said, well, why didn't they just open the shoe factories and make shoes for the children? And she said, it doesn't work that way. But I think it really was a puzzle to me that you had the same productive capacity in 1933 that you had in 1928. And in 1928, people were dancing to Charleston. And in 1933, they were in bread lines. And that really impressed on me, that economics can make a really big difference in people's lives. And monetary policy is like that. I mean, it's, as Jay, of course, and all of you well know, that the decisions made in this building have a very broad and real effect on people's lives. And for that reason, besides its intellectual fascination, it's worth studying and understanding.
Yeah. Thank you. I know that's certainly a key motivation for many people in this room to be working so hard. Okay, let's now turn to some topics of more current interest. And I'd like to start with the nexus between the financial system and the macroeconomy. Both of you, during your tenures as chair, have faced very significant historic financial crises. Ben, obviously you confronted the global financial crisis, and Jay, the global pandemic. Those episodes were clearly acute, very vivid examples of the connections between the macroeconomy and the financial system, as well as, I think, a good illustration of the role of central banks in such episodes. But Ben, your research, importantly, and the research that you have inspired, has really demonstrated that understanding the connections between the financial sector, credit markets, and banks and the real economy is critical for even understanding traditional business cycles. So with that as background, we have just experienced a period of stress in certain parts of the banking system here in the United States. So I want to get your take on those developments, how you think they match up compared to some previous episodes, and what they might mean for the economy.
Well, in some dimension, the recent crisis has followed the standard sequence. I don't know anything about Silicon Valley Bank other than what I read in the paper, so please don't misinterpret this. But it was a classic situation where they had assets that were subject to risk. In particular, as interest rates rose, the value of their long-term assets fell and their capital fell. They had hoped to hedge that by their deposit franchise, where as interest rates rose and interest rates moved more slowly on deposits, that would partially compensate. But they were dealing with customers who were very social media savvy, and that didn't really work. So after the decline in capital, you had the second stage, which is runs, people taking out their money, which ultimately led to the collapse of the bank, despite, I may add, good efforts of the Fed and the FDIC to provide liquidity and provide support for depositors. The third stage of a banking crisis is contagion, and people looked at other banks and said, oh, they look sort of vaguely like Silicon Valley Bank. They got the same number of letters in their name and all kinds of things like that, and that caused people to begin to remove deposits elsewhere. And finally, the reason this is important is that it ultimately affects credit conditions. And the Federal Reserve is, of course, looking at the effects of bank problems and other financial issues on the extension of credit and therefore on the real economy. So, in that respect, I think it's very similar to other crises. I think it's different from the global financial crisis in many ways, including its scale and scope, of course. But I would mention a couple of things, a couple of important differences. One is that the impaired asset in this case was U.S. Treasuries, which are very different assets in kind from subprime mortgages, in that U.S. Treasuries can always be valued accurately, and so there's not the uncertainty that was associated with subprime mortgages. And secondly, as the economy declines, if it does decline, U.S. Treasuries actually become more valuable rather than less valuable, and so there's kind of a countercyclical effect. So that's one very important difference, I think. And then the other worth mentioning, but very important, is that relative to, say, the GFC or the Great Depression, overall, borrowers are in much better shape, than they were in these previous episodes. And that makes a big difference, both in terms of the stability of the banks and also in terms of the impact on consumer spending and the economy in general.
Well, I guess a major reason that situation didn't get worse, and I think the contagion was very much contained, were the forceful actions, Jay, that you and the Federal Reserve took through the use of your liquidity tools, including the creation of the Bank Term Funding Program. However, in deploying these liquidity tools, that has come at, against this backdrop where the preeminent monetary policy concern is high inflation. And that's, of course, a little different from some of the earlier episodes, and has raised renewed discussions about the so-called separation principle, right? And so I wanted to ask you how you think about the use of financial stability tools and liquidity tools as opposed to more traditional monetary policy tools and how they fit together.
It's an interesting question, but I want to start by saying, though, that the overall, the banks and the banking system are strong and resilient and well-positioned to deal with the challenges they may face now or in the future. So, as you pointed out, we do have separate tools, monetary policy to achieve our macroeconomic objectives, liquidity, supervisory, and regulatory tools to address financial stability issues. But I see an important distinction between separation, this is the separation principle, separation and independence. Our tools can have separate objectives, but their effects are often not entirely independent. So the tools are complementary almost all of the time because financial and macroeconomic stability are so deeply intertwined. In fact, our consensus statement notes that sustainably achieving maximum employment and price stability depends on a stable financial system. So because they're so intertwined, to me, there is not likely to be an absolute and complete separation of the tools, nor is that possible or desirable. And I think as Ben's research and the global financial crisis demonstrated, financial stability affects macroeconomic stability and vice versa. We saw that clearly at the outset of the pandemic. As a result, the tools that we use to address concerns in either arena can and will affect both, especially during extreme circumstances. That said, yes, the tools are separate, they have individual purposes, and most of the time each can be used for its intended purpose without compromising the other. For example, as you pointed out, when banking stresses emerged in early March, we used our liquidity tools, the discount window and the Bank Term Funding Program, to make liquidity available to banks that might need it. And that liquidity supported the stability of the financial system without restricting the use of our monetary policy tools to promote price stability. While the financial stability tools help to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So as a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain.
Okay, thank you. And of course, I think the effectiveness of those tools is reflected in the fact that the FOMC has actually raised interest rates twice since the emergence of the banking strains. Of course, and the purpose of that is to confront the inflation issue, which brings us to our next topic, which is in fact inflation. In the pandemic and the aftermath, we've had many renewed discussions of the important and classic textbook distinction between supply shocks and demand shocks, and in particular the particular challenges that a supply shock can present to a central bank. And that's also raised a lot of questions in academia and in policy circles as to whether or not the inflation process post-pandemic is going to look quite different than prior. Jay, maybe we can start with you. A number of folks have argued that we are entering a new period where supply shocks will be more frequent. Would love to hear your views on whether you think that's a possibility and what that might mean for central banks.
So it's a great question, and it's one I think we'll be dealing with for quite a long time. And I'd say it's certainly possible that we'll see continued supply shocks. I also think it's just very hard to forecast that with any confidence. As Yogi Berra is thought to have said, Ben, you're the baseball expert, you can confirm or deny this, but it is difficult to make predictions, especially about the future. So I think that the best we can do at this stage is probably to just identify the factors that we think can lead to further negative supply shocks. I will say that, though, that positive supply shocks related to globalization largely probably contributed significantly to the period of low inflation that either ended or was interrupted by the onset of the pandemic. And I'm thinking there of the vast increase in global labor supply, the development of efficient global supply chains, facilitated by technological advances and things like that. And I would say those positive supply shocks do not seem likely to be repeated. At the same time, the drivers of the current inflationary surge certainly included a sequence of large negative supply shocks to the global supply chain for goods, which also experienced a large and persistent shift in demand from services to goods, and also the supply of workers. On top of that, Russia's war against Ukraine brought further shocks to global supply chains, particularly supplies of energy and non-energy commodities. So we can't know how persistent those shocks will be or whether further negative supply shocks will come along. Will globalization be partially or fully halted or reversed? Will it resume again as the pandemic mercifully recedes into memory? We can't really know that now. But for policymakers, the bottom line is that central banks will continue to be responsible for providing price stability, and that will require us to navigate whatever additional supply shocks do occur. So as Tomas and Ben and their co-authors wrote in the inflation targeting book, what a central bank can do is control inflation. And that is true over time, even in the presence of supply shocks, should they come.
Ben, I'd love to hear your views on this.
So unusual events which disrupt normal economic functioning often are followed by inflation. Examples are World War I, World War II, the Korean War, and now the pandemic. And the pandemic just makes it harder for policymakers to understand what's happening and to react appropriately. And in particular, the pandemic scrambled the labor market, made it harder to judge the state of the labor market. The opening led to a very extended rise in commodity prices, which was difficult to deal with. We had supply chain issues, which was pretty much a new thing, which was also a contributor to inflation. So there are many features of the pandemic that made this an unusual episode and a difficult episode to address. That being said, I think that, and I've done some research on this with Olivier Blanchard that we're presenting next week, the basic mechanisms, I think, are still the same. But you have a bunch of bad shocks, that's going to give you a problem. But the underlying mechanisms of supply shocks and tight labor markets and so on are really the same. So I think, I don't think there's been a major change in the underlying process that generates inflation, only a series of shocks related to the pandemic that gave us this episode. Going forward, I agree with Jay that we can't predict, what new shocks will come. We've got new technologies out there that might, make big changes in our economy. We've got, green investment, things like that might affect the price and availability of fossil fuels. And so there are many, many things that we can't predict. But I think that broadly speaking that the inflation process has not changed, and it's one aspect of that, which is very good news, is that the Federal Reserve's credibility has helped keep inflation expectations, particularly longer-term inflation expectations, reasonably well anchored, which is always sort of the first step in getting control of inflation.
You mentioned the role of the labor market tightness in the inflation process. I think it's quite striking that right on the eve of the pandemic, the unemployment rate was around 3.5%, a 5-decade low. Yet at the same time, inflation was kind of struggling to get up to 2% on a sustained basis. Here we are in 2023. The unemployment rate is roughly at the same level as it was prior to the pandemic, but of course inflation is far above 2%. So in that context, should we be thinking about the relationship between slack in the labor market and inflation differently? Do we not have the right measures of slack? Is it the problems with understanding what the natural rate of unemployment is? Or is slack really not the key to understanding inflation in the first place? Dan, you want to take that one first?
As I was talking about before, I think that the pandemic, to some extent, scrambled the usual signals from the labor market. And the Federal Reserve, over time, has begun to put more weight on things like the vacancy to unemployment ratio, which seems to give a better signal in a period of change when the labor market matching process is in change than the unemployment rate. So there has been some scrambling of those signals. That being said, it's simply not true that, even in people who've understood since the 70s that there's not a simple inverse relationship between inflation and unemployment. In particular, what can break that relationship is supply shocks. And so during the 70s, we didn't particularly have tight labor markets most of the time. We had high inflation, because we had oil price shocks, which the Fed did not respond to adequately, B, because inflation expectations were not well anchored, and there was a strong tendency for price increases to feed into wage increases, to feed into price increases. So because of the presence of supply shocks and inflation expectations dynamics, there's no reason why low unemployment and high inflation can't coexist, but the remedies might be, depending on the situation, might be somewhat different.
Jay, how are you thinking about that?
So I'm very much in agreement with that. It's certainly true that we had both before and after the pandemic unemployment very low, close to 3.5%, but that we only had high inflation after the pandemic. Does that mean that our understanding of the relationship between slack and inflation is badly wrong, or that it has changed fundamentally after the pandemic? And my answer would be tentatively no to both of those questions. I think what really is different this time was the series of unexpected and persistent supply shocks that featured in the inflation process. I don't think labor market slack was a particularly important feature of inflation when it first spiked in spring of 2021, By contrast, I do think that labor market slack is likely to be an increasingly important factor in inflation going forward. In particular, inflation in non-housing services is showing signs of real persistent. In this highly diverse sector, labor costs are a high proportion of total costs, and that sector happens to account for more than half of the core PCE index. But all of this, the point is, all of this can be explained, I think, using our standard framework for understanding labor market slack. You could say it this way, that the natural rate of employment probably rose sharply as the pandemic severely disrupted the labor market. And the implication of that would be that an unemployment rate of, say, 4% indicated a much tighter labor market in 2021 than it did in 2018. And as Ben mentioned, of course, after the pandemic, we began looking at much more closely at alternative measures, particularly vacancies, but also quits, which have been signaling even greater tightness than the unemployment rate alone might have thought to have been to signal. I mean, to put some numbers on it, we at the end of 2018 and the end of 2021, we had 4% roughly unemployment in both cases. In 2018, the vacancies to unemployment ratio was 1-to-1, essentially. In 2021, it was 2-to-1. And that was a much better indicator, obviously, at that time of the simple standalone unemployment rate. Although, as I mentioned, you could also think of it as the natural rate being highly elevated. The other thing is, it may also be the case that the Phillips curve has steepened, meaning that inflation has returned, at least for now, to being more responsive to changes in the labor market slack. But the Phillips curve was once thought to be fairly steep after flattening. Relationships in the economy, like the Phillips curve, evolve over time, so I would not characterize that as a problem for our understanding of inflation.
Very good, thank you. Maybe we can pivot here to the topic of central bank communications. It's widely understood now that the better the public understands the conduct of monetary policy, the more effective it will be. But fostering that type of understanding really requires a lot of communications, and of course, that can be hard. Both of you have been powerful advocates for advancing monetary policy communications, both with an eye toward making policy more effective, but also for the purposes of promoting transparency and accountability. Ben, you've obviously played a critical role here, advancing the FOMC's communications, including the introduction of press conferences after FOMC meetings, the introduction of the summary of economic projections. So what changes over this period since the communication, say, revolution began, would you highlight as being some of the most effective, most important, and where do some remaining challenges exist?
Well, let me talk about communication, because I think you need to understand that it serves multiple purposes. I mean, one of its purposes, the narrow purpose, is to try to align market expectations with the Fed's own thinking. I think that goes back to Alan Greenspan. You go back to 1994, the first FOMC statement. I mean, since then, the Fed has tried at least to give some indication of what it's thinking and what it sees as the risks to the economy. But beyond that, you mentioned transparency and accountability. This is a powerful institution. It's very important that it be accountable to the Congress and to the public, and the best way to do that is explain what we think, what we're doing, and how we're going to go about that. There's other reasons for communication. One I would talk about is feedback. We're having a conference here. If the Fed puts out the issues that it's concerned about, economists will write articles or tweet and respond to that. Or in the case of the Fed Listens program, maybe it would be more ordinary people who are explaining, how monetary policy affects them. One final thing I would mention is diversity of views. Because the Fed has a consensus culture, and there are very few dissents normally, the outside perception is the Fed is subject to groupthink, which of course is possible, but with people talking about their own views and explaining why they see the economy as they do, it does, I think, at least to some extent, show that there is a range of opinion on the committee. In terms of tools, I guess I do feel proud about the press conferences, which I introduced 4 times a year after the summary of economic projections, in which Chair Powell has taken to an art form. And I think also, just the inflation target, the forecasts that we release, and there's a cultural change, which some people don't like, but I think on net is good, which is, it used to be, if you look back at speeches in the Greenspan era, the president of the Federal Reserve Bank of Minneapolis, would talk about, harvests or something, wouldn't talk very much about the global or national economy. Now you have a lot of people talking about, the different aspects of the Federal Reserve's views. And again, that contributes to both market transparency and also to accountability to the local constituency and to the national constituency.
Jay, you, of course, have continued to push forward on the communications and transparency fronts. Welcome your thoughts.
I think the broader setting is that transparency is especially important today. Polling data show that many important public and private institutions globally have struggled to retain the public's trust and support in recent years. Now, we're an institution that serves a critical public mission, but to be here and work here is to know that the particulars of what we do and how we do it are not generally top of mind for most people. And on top of that, we have a critical and a rare grant of independence. And all of that, to me, means that we have a special obligation to explain ourselves clearly, what we do, why we do it, to provide transparency to the public and their elected representatives in Congress so that we can earn and deserve their trust and support. And that's a critical task if we are going to sustain our democratic legitimacy through this interesting period. My colleagues and I really take that as a primary and affirmative, proactive obligation and not something we see as a burden or of second-order importance. So in that spirit, to your point, we have followed the example of Chairman Greenspan, beginning in 1994 with the first post-meeting statement, through Ben's innovations and Janet as well, in looking to foster greater transparency and accountability. And a couple of examples, we now do a press conference after every meeting, not just every other one. We have greatly expanded our congressional outreach to be certain that we hear directly from lawmakers on an ongoing basis, so that they have the information that they need to conduct appropriate oversight. As I mentioned, in 2019 and 20, we conducted a public review of our monetary policy framework, seeking input from a broad range of people and groups all around the country. We've also significantly expanded transparency beyond monetary policy. For example, we now publish semi-annual financial stability and supervision and regulation reports. Of course, there are always communication challenges, especially I find about communicating the uncertainty that attends our assessments of economic conditions and the outlook. And the good example of this is, despite our persistent efforts to explain otherwise, the policy paths from the SEP seem regularly to be taken as a firm plan or a committee decision, rather than what they are, which is a compilation of individual participants' best assessments on a particular day of appropriate policy under the assumption that conditions evolve in line with their baseline forecasts. So that's just a challenge that we constantly face in the context of great uncertainty. Despite that, I would say, though, that the summary of economic projections has actually been very useful during this tightening cycle as markets have looked ahead and priced in future rate hikes, long before they're actually implemented.
Your last point really brings up the idea of communications as being an effective policy tool. And I guess the key element of that is the use of forward guidance. Jay, in one school of thought, forward guidance is a tool that should really only be deployed when interest rates are at the effective lower bound. And so you can no longer provide accommodation by lowering rates further, and so you do so through communicating about the policy path in the future. But another school of thought, forward guidance should be just a regular part of communicating with the public to convey the committee's policy intentions, even far away from the effective lower bound. Where do you come out in that debate?
Well, I do think it depends on circumstances. I do think that forward guidance can be useful when policymakers have a materially different or clearer view of the likely path of policy than does the interested public. I would agree at the effective lower bound when we need to provide more stimulus by indicating an intent to keep policy accommodative longer than the public expects. There's a use case there. I also would say, though, that communication comes with a cost of misinterpretation, and it also may limit flexibility. So I think we should use forward guidance sparingly when the course of policy is either reasonably well understood or, on the contrary, is so dependent on uncertain future developments that little really can be said constructively about the future. And a good example of that was the March 2020 FOMC meeting. The pandemic shutdowns were just beginning. The level of certainty was almost unimaginable, and we chose not to issue an SEP at that point. Really, our view was that releasing a forecast at that time might have been more of an obstacle to clear communication than a help. In contrast, as I mentioned a minute ago, forward guidance has really been a useful and effective tool during the current tightening cycle, as financial conditions have tightened well in advance of actual rate increases. You know, the 2-year tightened between the September 21 meeting and liftoff in March of 20. It tightened by 200 basis points before we ever actually lifted rates, and that's significantly because of our communication. So in the current context, until recently, it's been relatively clear that further policy firming would be warranted, and our forward guidance has said so. Now, however, we've come a long way in policy tightening, and the stance of policy is restrictive, and we face uncertainty about the lagged effects of our tightening so far and about the extent of credit tightening from recent banking stresses. So today, our guidance is limited to identifying the factors we'll be monitoring as we assess the extent to which additional policy firming may be appropriate to return inflation to 2% over time. As I noted at the last press conference, that assessment will be an ongoing one as we move ahead, meeting by meeting. Having come this far, we can afford to look at the data and the evolving outlook and make careful assessments.
Thank you. Jay, you mentioned that guidance can be useful at times when the public may expect a very different policy path than policymakers. How do you think about those sorts of situations?
You're right. So recently it has sometimes been the case that markets appear to be pricing in a different rate path than the committee expects will be appropriate. But I would say that disconnect does not seem to reflect a misunderstanding of our reaction function or a lack of belief that we'll do what's necessary to bring inflation down. Rather, it appears to reflect simply a different forecast, one in which inflation comes down much more quickly than the committee participants think is most likely, perhaps due to a significant downturn. I would say also, so far the data have continued to support the committee's view that bringing inflation down will take some time. Moreover, something we often don't remember to think about is that market prices always reflect both expectations and compensation for risk. And what market participants say in surveys of their expectations is actually closer to the views in the SEP than what is reflected in market pricing. So ultimately, my colleagues and I have our forecasts, and market participants have theirs. Our role is not to advocate for our forecast. What we can do is be clear about our expectations for growth, unemployment, and inflation, and the likely implications for policy. As well, we want the public to understand how policy would react if the path of the economy were to differ materially from our expectations. And of course, we do lay out our individual forecasts quarterly.
Ben, what would your takeaways be for the past couple of decades' use of forward guidance as a policy tool?
Well, Charlie Evans and co-authors have made a useful distinction between what they call Odyssean and Delphic forward guidance. So Odyssean forward guidance is a commitment forward guidance, which is rarely used, but typically at the lower bound, where the central bank promises to do something, and its credibility on the line, that it will follow a certain path going forward, and that's a way of getting more stimulus. And I think, again, that goes back, again, to Alan Greenspan, I think, to indicate that a certain path was very likely, and that actually helps achieve the objectives. Delphic forward guidance is basically just a forecast. Here's what we think. Tomorrow we might think something different, but we're just trying to, as part of our transparency, we're just trying to give you a sense of where the economy is going and how we think policy will react. Now, as Jay points out, there are some problems in practice. One is people don't understand the difference all the time between a commitment and a forecast. That's something that Jay has emphasized, and I think should be emphasized. Another is people underestimate the amount of uncertainty involved, which is enormous. So I don't think you can do without some form of forward guidance, because the idea of transparency says, here's what we see, and here's why we're thinking. And so the idea that there's no guidance at all, most of the time, I take March 2020 as a counterexample, but most of the time you do want to give at least a sense of where you think the economy and accordingly policy are heading. I think, just if I might editorialize one more minute, I think one of the issues is that the FOMC is so large and geographically dispersed that it's been difficult to come up with a collective committee forecast. We tried to do that when I was chair. The dot plot is a compromise, which is not ideal. Other central banks do other things. Sometimes they have collective committee forecasts that are voted on, or they use market rates, or they publish the staff forecast. So there are different ways to go about this. But again, I think that forward guidance is both an instrumental tool, but again, letting people know sort of how the central bank sees the evolving situation, even if there's lots of uncertainty, which you can say, normally is part of transparency.
So you highlighted uncertainty as being a key factor in dealing with some of these issues. Obviously, uncertainty is a pervasive feature of monetary policy making, and often invokes the so-called risk management approach to making monetary policy. Maybe we can start, Jay, with you on this topic. The FOMC's raised the federal funds rate by 5 percentage points in a little more than a year. That's a very rapid pace by historical standards, as we all know. How do you view those actions in the context of the uncertainties that you and the committee faced about the economic outlook, and how did risk management considerations factor into your decisions?
So I'll start by remembering that Alan Greenspan famously said that pervasive uncertainty was the defining characteristic of the policy landscape. It's worth remembering that he made that comment during what we now think of as the Great Moderation. So that statement has never been more apt than it is today. If you look back, the pandemic, the global shutdown, the historically forceful response and the reopening, all of that had no modern precedent. So it has been a time of historically elevated uncertainty and of unexpected outcomes. No advanced economy had ever faced a shutdown and a reopening, and now all of them would face it at the same time. So no matter what happened, the outcome was going to be unprecedented. So this level of uncertainty posed real challenges for policy and policy communications. On the one hand, we had to be nimble to be able to respond to the evolving situation. On the other hand, we wanted to be as clear as possible about what we were doing, lest we add to uncertainty. So I would say policy certainly has been nimble, consistent with what was in our expectations. The data did actually show declining inflation through September of 2021, but then turned decisively against that expectations thereafter. And in response, we accelerated our policy firming, ultimately, as you noted, raising rates by 500 basis points in just over a year. Over this period, we communicated that the object was to reach a stance of policy that is sufficiently restrictive to return inflation to 2% over time. But we also communicated that the level of rates that would ultimately be required was highly uncertain. Now, until very recently, it's been clear that further policy firming would be required. As policy has become more restricted, the risks of doing too much versus doing too little are becoming more balanced, and our policy has adjusted to reflect that fact. So we haven't made any decisions about the extent to which additional policy firming will be appropriate, but given how far we've come, as I noted, we can afford to look at the data and the evolving outlook and make careful assessments.
Ben, when you became a policymaker, you were well versed in sort of the academic literature on decision making.
Yeah, I moved from that side to this side.
Yeah. How does it work in practice?
I say uncertainty when you're an academic is trying to decide whether your error term is Gaussian or not. In actual policy making, you don't even know what the current quarter GDP is, because it's going to get revised, several times down the road. I remember when I was sitting just as a member of the board, and Greenspan was in the chair, and we had responded to some inflation data, and a little bit later, it turned out that inflation change had been revised away. And I asked the chair, do you think we can revise our interest rate policy? It is very difficult. I mean, got to laugh with that, but just trying to make policy, it involves not just uncertainty about, the data, about the model, about all the things that can happen, about the social and economic and political environment. So it's very difficult, and unfortunately, or fortunately, given that monetary policy works with a lag, given that there are risks on both sides of the modal forecast, there's not much choice but just to accept that uncertainty and try and do the best you can, being ready to adjust as new information arrives.
Very good. Thank you. We are getting close to the end of our allotted time. Maybe we could wrap up with just a question looking ahead. Jay, maybe we can start with you. What would you point to as some of the key issues that will be most relevant to the research community as well as to the policymaking community?
So I guess I would start with the labor market, and what we talked about earlier of vacancies in particular, and the beverage curve, and the whole discussion over whether the extraordinarily high level of surplus demand in the labor market can be lessened through the vacancies channel without a significant increase in unemployment. That would be more akin to what has happened in all prior cycles, or most prior cycles. So that's going to be a question that we will resolve empirically. But I think we're learning new things about the workings of the labor market, at least in this one situation. I think on monetary policy, it's going to be interesting to look back and try to understand how inflation spread from what was at the beginning, very focused on the goods sector due to the rotation of demand from services to goods and the tremendous amount of support that goods purchases got from fiscal and monetary stimulus. How did it spread then through really into the service sector where it now significantly resides? I think we're seeing much progress on goods, and we have progress in the pipeline on housing services, but where we see persistent inflation is now in the service sector. So what is the mechanism by which that happens, and what are the implications?
Ben, you have the last word.
Well, I think one of the things that I would urge researchers to look at is the relationship between monetary policy and financial stability. A very, very difficult relationship. If you read the papers, you see that everybody has a very strong opinion about this subject, but they don't necessarily correlate. As Mark Twain once said, the things you don't know can hurt you as much as the things that you know for sure but ain't so. I think that we really do not understand, to the extent that we need to, the relationship between different aspects of monetary policy, risk-taking, balance sheet behavior, et cetera. It's just something, there's a lot of good work being done, don't get me wrong, but I think we need to understand much better what the channels are and to quantify the relationship so that we can think about to what extent we need to take that into account in monetary policy.
Very good. Well, let me thank both of you tremendously for sharing your perspectives with us today. It's been a highlight of our conference honoring Thomas Lobach, and so thank you very much. Round of applause.
All right, well, that's the end for that. Didn't really get much update, kind of a non-event, but we do have some news coming out about debt ceiling talks. One of the GOP negotiators was saying that they haven't come to a deal yet, so markets down a little bit, not very much after Powell started to speak, but let's see, we started at about 420 down to 418.79. You've got support at 418.21 Fibonacci level that we squeezed at last thing before close yesterday. So that's the important level to be looking out for right here, whether above or below it. We had a squeeze below it. Now we're having a little bit of a squeeze above it. So definitely watch out for that line at 418.21. Looks like QQQ is actually performing the best out of the indices again today, surprisingly. Only down 0.1% versus IWM down the worst, 0.7, and Dow is down 0.3. So very odd price action going on. I would have thought that it would be the opposite, where IWM would be the best performing, just because of how far it's been selling off, but it does have that range at like 177, 178. So rejection from that range obviously has sent that down pretty substantially back down to the middle of the range. But Yeah, that's all the trades for today. Still got my put debit spread assuming under 418 Monday. Still got my AMAT put debit spread assuming under 126 next Friday. Still holding the SOX S position of 100 shares. I think this one is going to be pretty good one, just considering that semiconductor shares have been doing so well. I would imagine, this pullback that we've started to see today could unwind a little bit more for names like Nvidia that have been trading up relentlessly from 290 just a couple days ago to 312 right now. So could see a pullback for Nvidia. Obviously that would send SOX S up. That would send AMAT down, which would be great for this trade. Right now SPY's trading at 418.50. It's not really changing too much, but it is slightly more down. We're looking at 40 for RSI, so it is bearish. And again, you're looking at that 418.21 level, where we'll squeeze or not. But yeah, that's all I have for y'all today. I'm going to set an alert for if we go below 418.21. Gonna let me know that we're squeezing to the downside later on. At or below. And right now we're about 50 cents above it, so. QQQ down 0.2, IWM the worst 0.7, so. We'll see how today shakes out. My guess is that you'll see probably the most coming out of SOX S, Nvidia, probably AMAT for today. But yeah, I'll catch y'all on what about SPY at 422. Let's see. I would doubt that we would get way back to 422 by the end of the day. We're definitely looking bearish now after that meeting started at 11 o'clock. So my guess is we continue the bearish trading action given the last 2-day rise. But yeah, that's it for today, and I'll catch y'all on Monday at 9:30. See you, everybody.